Hello and thanks for joining us at interest.co.nz. I'm Janae Tibshirani and today I'm joined by the Reserve Bank's Chief Economist, Yuong. Welcome, Yuong.
Kia ora, thank you.
The Reserve Bank surprised a few of us when it cut the OCR by 50 basis points on Wednesday. Some of us might be thinking, what more can cheaper money do to stimulate the economy when some of the headwinds the economy is facing, like the US-China trade war and uncertainty over a new government, where these things don't actually relate to the fact, relate to the cost of money?
Well, for us, it's business as usual, and I know people have been shocked and surprised in various headlines and talking points about what we're doing, but for us it is basically business as usual. We have a mandate, and that is to achieve 2% inflation over the medium term and to continue to support full employment. So when we look at the macroeconomic situation, the economy is in a reasonably good spot right now. Sure, growth has slowed. The labour market's strong, the recent data confirm that, but looking ahead, we can see some of the growth headwinds you described. The world is looking weaker now than it was this time last year, and we need to factor that in. We look at the near-term growth indicators for New Zealand, and they're also looking to soften.
Sure, but how does making it cheaper to borrow money address some of these issues which are actually causing the headwinds? How can you be certain that governments, households and businesses will actually spend more if it is cheaper to borrow, when actually it's already been really cheap to borrow and this is sort of the economy is still in the position it's in now?
That's a great question, and I think you're sort of getting to the heart of, is monetary policy still effective at these low interest rates? And our bottom line is yes, monetary policy is still effective. The world may be changing around us, changing in very different ways, and we may have to react differently. But the bottom line is interest rates still affect investment and spending decisions the way they always have. We looked at some international work and our own recent work, and there's no evidence to suggest that policy is any less effective at these low interest rates.
Okay, but we're going into uncharted territory here in the New Zealand context,
sure,
at least. So can you explain a little bit more about the research that you are looking to that actually says, okay, when we're cutting at these low levels, the intended effect will be this?
It can get a bit arcane, so you have to bear with me. I guess at the very simple level, the most immediate way we think of are changes in the official cash rate passing through to retail interest rates that households and businesses face. And to a large extent we think, yes, they are. There's a little bit of a change since the financial crisis because banks themselves rely a lot more on deposit funding. So the pass-through from official cash rates to deposit rates tend to be a bit slower, and hence ultimately the pass-through from OCR to mortgage rates tend to be a bit slower. But when you sit back and look at the sum total of when impact of interest rates on economic activity, they still look like they're playing out as they always have done. That gives us confidence that we can influence economic activity, we can influence inflation,
sure.
So we're going about our business.
What about I know that Governor Adrian Orr isn't that sort of big on the idea of diminishing returns, which is basically the lower the OCR is, the less bang you get for your buck with each cut, because banks can't pass through that sort of full amount. Why is this not a concern for the Reserve Bank?
Well, again, it sort of comes back to the effectiveness. We've got no evidence to suggest that we're hitting a tipping point where suddenly policy no longer works. We have been watching and we will be continuing to watch how OCR changes are feeding through to retail deposit rates and hence to economic activity, but the working assumption is, it's business as usual.
Okay, look, talking about business as usual in terms of what is not business as usual is if we go into negative interest rates.
Sure.
How likely is this?
In a statistical sense, it is in the realms of possibility. It's not our forecast right now, but I was sitting here with an OCR of 2.5%, thinking that was as low as we would need to go. The world keeps changing on us and we need to react. And here we are with an OCR of 1%. We're saying we are now recognising, and everyone should recognise, we are in a low interest rate environment. Interest rates may need to go lower from here. How low, we don't know, right?
Okay, in terms of what it would actually mean if they went to negative, say you cut to negative 25 basis points, what would that mean for me if I wanted to get a mortgage?
Yeah, fundamentally, when we're changing interest rates, we're altering the relative rate of return on borrowing and spending today versus saving and spending in a year's time, for instance. The same dynamics work at positive interest rates as at low interest rates. So let's have an example. Say you had $100 in the bank, and now, for argument's sake, you in a year's time, you only got $95 back because interest rates were negative, so in this case, minus 5%. You would have to make a decision, is it worth spending $100 now versus getting $95 in a year's time and spending and getting $95 worth of goods and services? We're trying to say it's actually more effective to spend now, and we actually want people to wake up to reality.
What would happen if I wanted to get a loan?
Same thing. Loans are lower. So the hurdle rate for borrowing, the hurdle rate for investing should be lower. That should stimulate people.
But how much, that's the thing, is how much lower could that go? How much, I mean, this is really, I suppose, a question for banks, but in terms of how much lower could they cut those rates?
Again, that's a great question. It is ultimately a question for banks. I mean, if we want to throw some broad numbers out there just to give you
Not letting you off the hook, though. It's a question for you too.
When we look at it, average size of deposits across households is about 100,000. The average mortgage size is 400,000. So assuming the same interest rate cut on deposit rates as borrowing rates, the cash flow impact to households is 4 times larger for those with a mortgage than those with a deposit. So on net, we think lower interest rates will stimulate more borrowing, more spending, and more economic activity. Okay,
asset purchases. Could you just explain to us exactly what this is and how that might work? That's another mechanism that's in your toolkit that you could use, right?
That is. It's part of the broader heading that people have labelled quantitative easing. We're doing some work now. We don't have all the details, and I don't think we'd reveal all those details anyway, but at the heart of it, asset purchases is simply a way of trying to lower interest rates across the yield curve. So when interest rates go negative, there is some limit to how negative they can go, and central banks around the world have resorted to other tools to push particularly the long end of the interest yield curve down by purchasing assets.
Okay, the thing that I suppose is a little bit worrying is that the Reserve Bank has moved quicker than everyone expected by cutting by 50 basis points. And I know what you're saying, you're front loading it. If you do it 50 now, it's better than doing 25. That's fine. But should we not, by this point, if we're getting this close to potentially getting to negative interest rates, have some publicly available information and data that says, look, this is the research for this scenario and for that scenario, and have it in more detail? And I know the governor said at the press conference that a lot of this was market sensitive, which is why the RBNZ couldn't go into more detail.
That's right. We are doing our own due diligence about if negative interest rates potentially on the horizon, how would we do that? And that's we'd be negligent if we weren't. The issue about is monetary policy still effective, we are doing research on that because it is important to give people confidence that monetary policy still works, and we will have research published pretty soon on that. And then when you scan across the international experience, many parts of the world have lived with negative interest rates for a while now. The equivalent of the OCR in Europe has been negative since 2015, I believe. Japan's had negative interest rates, Sweden, Switzerland. This is part of the normal everyday landscape of central banking toolkit now.
Okay, so we'll see some research on the effectiveness of cutting the OCR at low rates soon?
We'll see the effectiveness of changes in interest rates. Do changes in interest rates affect the real economy in the same way?
Okay, so in coming months, weeks?
I'd say in the next 2 months, yeah.
Okay. And in terms of more research on some of these different options or different things
that's ongoing, so that's to be determined.
Okay, so we're just trusting that the Reserve Bank is well and truly researching these options very thoroughly.
We are on the game and we're fully prepared. That's right.
Okay.
And I do need to say, we are committed to achieving our mandate. We're not shying away from the fact that interest rates may need to go negative, or we may need other tools. And it would be incumbent on us to prepare for that eventuality. But we need to get a message out that the central bank is absolutely committed to our mandate of getting inflation to 2% and continuing to support full employment. Okay.
Talking about that mandate, some of us might be looking at this thinking, well, actually, is the way monetary policy works, is it too myopic? So what I'm saying is that the Reserve Bank has this mandate, which you've said to target unemployment and inflation, or employment and inflation, and you have a bunch of tools, and you use those tools to reach that target. And if there are sort of flow-on effects, like on the housing market, you've got other tools like the LVRs, which you can employ, but you're just focused on achieving that target. And then the government is doing its thing, Treasury's doing it, helping the government do its thing. But actually, this is a philosophical question, but do you think that model works, or actually do we need a broader sort of approach towards this, where perhaps monetary policy and fiscal policy, there's a policy for them to work more closely together?
It's a really interesting question and way above my pay grade. It's an interesting point. I mean, I'd say we have expanded our mandate. We recently had a review of the Reserve Bank Act, and it was addressing some of those concerns about where we've been too myopic and only focusing on inflation. So as a result of that, we now have an inflation and an employment mandate. The issue about, well, how do you coordinate with other types of policies, it's probably a general point that, monetary policy needs friends, and to the extent that other fiscal policy or other policies might provide more economic stimulus, that would be welcome. But in terms of some of the more deeper philosophical institutional settings,
Okay. I know it's a big question, and I can only imagine the saga that would be necessary for that to change. But I guess that's the thing, is that you can't force someone to be friends with you. You can't force the government to ramp up spending, I suppose, is the thing. And that's kind of where I wanted to go next, was with fiscal policy. I feel like a lot more pressure perhaps is on Grant Robertson to spend more, to do so that the government does its bit. What I'm wondering is, in your forecasts, you've assumed that fiscal stimulus is going to happen. So at the budget, the government put a whole bunch more money aside and said, look, we're going to spend all this money. But history shows that actually it hasn't been able to get the money out the door as quickly as it's assumed. But you are assuming that looking ahead, it will be getting that money out the door, right?
That's right. Well, we are taking numbers from the budget, which were prepared by Treasury, and they've already put their lens on the government intentions to spend, and then they've gone and said what are the practical realities of how quickly they can get that money out the door. So there's already been a one haircut, if you like, and the Treasury are the experts, and we trust their numbers, so we've just put them into our forecast.
Right. So
I understand the question about can they do more and how quickly, but at face value, we trust the Treasury numbers.
Right. So the real stumbling block to the government spending its money is capacity constraints, right? There just don't seem to be a whole bunch of people with the skills necessary to build the infrastructure that we need. And this brings us to the question of migration. Do you believe that actually we do need more people than the forecasts suggest, which are going down, to carry out the fiscal stimulus that you're relying on?
I guess the point of fiscal stimulus can take many forms. It can be through more spending, more infrastructure spending. The issue of capacity constraints in general, again, it could be through more workers or it could be through more investment. We'd love to see more capacity, and interest rates are one path to bringing that about.